Welcome to Market Brief After Hours. It has been an absolute whirlwind of a day on Wall Street, with major indexes suffering some of their steepest declines in recent memory. If you're trying to make sense of the sea of red on your screens today, you are certainly not alone. The market was hit by a perfect storm of central bank anxiety, geopolitical flare-ups, and a continued rotation out of technology stocks.
That is an understatement. It was a massive, broad-based sell-off. The primary catalyst was the bond market's reaction to the Federal Reserve's latest interest rate decision. Investors are increasingly worried that the central bank might be falling behind in its fight against inflation.
Let's get straight into the numbers because they are quite stark. How did the major U.S. indexes wrap up the session?
The Dow Jones Industrial Average plummeted 1,153 points, or 2.19%, to close at 51,594. That marks its worst single-day decline since April 2025. The S&P 500 didn't fare much better, sliding 1.52% to end the day at 7,316. And the tech-heavy Nasdaq Composite fell 1.74% to close at 24,443. Which officially pushes it into correction territory.
And this was all triggered by the Fed choosing to stand pat on rates, correct?
Exactly. The Federal Open Market Committee voted 9-3 to keep its key interest rate steady in a range between 3.5% and 3.75%. But that 9-3 split is highly significant. It shows that 3 policy members actually dissented because they wanted to raise rates by a quarter percentage point. Fed Chairman Kevin Warsh tried to strike a tough tone during his press conference, emphasizing that the committee will not hesitate to act when necessary. However, his rhetoric failed to convince the bond market.
Right, and we saw yields react almost instantly.
We did. The bond market essentially called the Fed's bluff. The 10-year Treasury yield jumped 7 basis points to climb above 4.67%. Even more telling was the long end of the curve. The 30-year Treasury yield surged 10.5 basis points to close at 5.201% after hitting an intraday high of 5.244%. That is its highest level since July 2007. Meanwhile, shorter-dated yields actually fell, with the 2-year Treasury yield trading 4 basis points lower at 4.236%. This divergence shows that while short-term rate expectations eased slightly, long-term inflation fears are very much alive.
Adding fuel to those inflation fears was a sudden spike in energy prices. What happened with oil today?
Geopolitical tensions took center stage after President Donald Trump announced that the U.S. would hit Iran hard in response to surprise ballistic missile attacks on American forces in Jordan. Fortunately, U.S. Central Command confirmed those missiles were successfully intercepted, but the news completely shattered the market's brief optimism for a de-escalation. As a result, Brent crude futures jumped 7.9% to close at $90.74 a barrel, and U.S. West Texas Intermediate crude surged 6.6% to settle at $84.46 a barrel.
That is a massive jump, and higher energy costs are the last thing a nervous market wants to see right now. We are going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we outlined the dramatic sell-off in the U.S. markets. Now let's widen our lens and look at how global markets responded. The global chip rout and tech anxiety seem to be keeping investors on edge everywhere, but some regions managed to find a silver lining.
Yes, it was a highly divergent day globally. In Europe, the pan-European Stoxx 600 index snapped a 3-session winning streak, closing down 0.3%. France's CAC 40 lost 0.6%. Switzerland's SMI fell 0.58%, Italy's FTSE MIB 30 declined 0.49%, and Spain's IBEX 35 dropped 1.59%. Germany's DAX managed to close flat, even as data showed Germany's import prices rose 6% year-on-year in June 2026. While that's an easing from May's 6.8% increase, it was still slightly above expectations, with electricity and petroleum remaining major inflation drivers. We also saw Italy's industrial turnover increase 0.6% month-on-month in May, and Greece's jobless rate edge up to 8.0% in June.
But the real standout in Europe was the UK, which actually hit a milestone today.
That's right. The UK's FTSE 100 climbed to an all-time high of 10,951 in early trading, before pulling back slightly to close 0.34% higher on the day. The UK large cap index has essentially become an anti-tech play. Because it has very little exposure to the highly volatile technology sector, it has served as a safe haven for investors fleeing the global semiconductor rout.
Speaking of that semiconductor route, Asia saw some incredibly intense trading sessions, particularly in South Korea.
Absolutely. The tech-heavy South Korean KOSPI 100 crashed 6.27% today. In fact, the exchange had to trigger a circuit breaker to halt trading for 20 minutes after the index plunged 8% intraday. This follows an 11% drop the previous day, putting the KOSPI about 42% below its June peak. Investors are aggressively rotating away from chip makers. In Japan, the Nikkei 225 fell 1.49%, dragged down by massive drops in tech names like Screen Holdings, which plunged over 17%, and Kioxia Holdings, which dropped nearly 14%.
Did any Asian markets manage to escape the carnage?
China and Hong Kong actually bucked the trend. China's Shanghai Composite rose 0.4%, while Hong Kong's Hang Seng Index advanced 1.96%, led by strong gains in electric vehicle maker Li Auto and tech giant Xiaomi. Australia's S&P ASX 200 also climbed 1.01% after annual inflation unexpectedly eased to 3.8% in June from 4% in May. That dovish data point led investors to sharply scale back expectations for further rate hikes from the Reserve Bank of Australia. New Zealand's S&P NZX 50 also gained 0.83%.
Let's pivot to the foreign exchange markets and gold, where we are seeing some key technical levels being tested. Let's start with the euro.
The Euro-USD pair managed a corrective bounce off its recent lows, closing up 0.57% at 1.1452. Structurally, though, the medium-term trend remains decisively bearish. The pair is trading well below all its major moving averages, with the 50-day simple moving average at 1.1485, the 100-day at 1.1567, and the 200-day at 1.1630. If it can hold above the critical support floor of 1.1375, we might see some consolidation, but it faces immediate overhead resistance at 1.1467 and that 50-day average.
And how is the British pound holding up?
GBP USD also recovered slightly, closing up 0.45% at 1.3349. It is currently navigating a very congested zone, trading just below its clustered moving averages. The 50-day SMA is sitting at 1.3363, while the 100-day and 200-day SMAs are practically on top of each other at 1.3396 and 1.3397. This flattening of the moving averages suggests the market is transitioning into a broader sideways range. Immediate support is firmly established at 1.3279.
What about the Japanese yen? It has been incredibly volatile lately.
The USD-JPY pair stalled near its recent cycle highs, closing down 0.22% at 163.48. Despite this minor pause, the broader trend is still powerfully bullish. The pair is trading comfortably above its key moving averages, with the 50-day SMA at 161.34, the 100-day at 160.05, and the 200-day at 157.84. As long as it holds above support at 163.23, the path of least resistance remains to the upside.
Let's also look at the Australian and Canadian dollars.
The Australian dollar retreated, with AUD-USD closing down 0.34% at 0.6949. It is trading below its 50-day SMA of 0.7013 and 100-day SMA of 0.7052, but it is currently resting just above its critical 200-day SMA at 0.6902. If it breaks below that 200-day average, it could signal a deeper trend reversal. Meanwhile, USD CAD pulled back 0.36% to close at 1.4056, testing its 50-day SMA of 1.4042. It remains well above its 100-day and 200-day averages, indicating this is likely just a corrective pullback within a broader uptrend.
And finally, gold. It had a massive intraday swing today.
Yes, gold closed up 0.54% at $4,050, but that doesn't tell the whole story. It rallied all the way to a high of 4,116 before aggressive selling pressure forced it back down, leaving a very prominent upper wick on the daily candle. Gold is still locked in a powerful medium-term downtrend, trading way below its 50-day SMA of 4,216, its 100-day at 4,473, and its 200-day at 4,483.
It needs to defend the 3,996 support level to keep this fragile relief rally alive.
Let's wrap up with today's individual corporate movers. Earnings season is in full swing, and it is creating some massive dispersion between winners and losers. Who stood out today?
Let's start with the gainers. Garmin was the star of the S&P 500, surging over 16% after reporting impressive second-quarter revenue of $2.02 billion, beating the consensus of $1.92 billion. They also raised their full-year revenue guidance to $8.05 billion. GE Healthcare also had a stellar day, jumping over 12% after posting adjusted earnings per share of $1.13, beating the 1.04 consensus.
On the flip side, we saw some devastating double-digit drops.
We did. Lennox International led the S&P 500 losers, plunging more than 20% after its second-quarter sales of $1.55 billion came in light. Vertiv Holdings also got hammered, dropping over 17% after its sales of $3.27 billion missed estimates. In the Nasdaq, Nebius Group fell more than 12%, continuing a brutal slide that has wiped out over 50% of its value since its June peak.
We also saw some heavy losses driven by regulatory news and after-hours earnings guidance.
Yes, shares of telehealth company Hims & Hers Health fell nearly 15% after the Federal Trade Commission filed a lawsuit against them, alleging misleading consumer practices regarding privacy and billing. And finally, after the closing bell, Meta shares fell more than 8% in extended trading. The company issued a weaker-than-expected revenue forecast and revealed a significant hit to its cash reserves, which is likely to keep tech investors on edge heading into tomorrow's session.
It is clear that volatility is back in a big way, and the upcoming inflation data is going to be absolutely critical for where we go from here. If you find this useful, please follow Market Brief after hours. We will see you back here tomorrow.